Okay, folks. The good news is next week is spring break, right? The bad news is it means you're officially halfway through this class. Why is it bad news? Because you've been putting off stuff. It's going to catch up with you really fast when you come back. So a couple of reminders. One is, remember I gave you that one-time deal of if you send me a DCF, I'll give you feedback. That's at the end of this month. That sounds like a long time away. That's a week after you come back from spring break. I know you don't want to do a DCF on spring break. You're going to Puerto Rico, right? Sit in the spreadsheet on the beach doesn't sound like a fun thing to do. No. But so if you can get something done before the end of this week, before you leave for the spring, at least you'll have, at least get started. The starting point is actually the most difficult part. You're putting it off and putting it, just enter the numbers, do a base case. You can always come back and tweak the numbers. Okay? So that's a reminder. Second is your quizzes, if you haven't picked them up, are upstairs. One word. I found out like 3 hours after I graded all your quizzes, and then somebody says, I looked at problem 3 and I don't see the word convertible. I said, that can't be right. I go and read it. You're absolutely right. There's a freebie, 2 points. Everybody got 2 points. And I'm sorry, I know it's for some of you who are stuck on that problem because that problem is unsolvable. It's actually a problem where the numbers are at war with each other. Zero coupon bond cannot sell for a market value higher than the face value unless you have negative interest rates. You think that's possible, but not in that problem because I gave you interest rates in the problem to be 5%. So pick up the quiz, and obviously everybody gets 2 points. So your score should not be lower than 2. That's the good news, right? The bad news is it can get very close to 2 if you screw up everything else. Now, for the most part, people did reasonably well. Pick up your quiz. And if you find there's a mistake in my grading, I thought about this. It doesn't work with office hours and doing it on Zoom because then you're sharing your quiz and other people can see it. I have to create breakout rooms. So here's the best thing to do. Take a picture of the page on which I've screwed up. Send it to me and say, look, you took 2 points off, but my answer is right here in the corner. Sometimes you wrote things all over the page. I might not have found it. And I'll put the grade back. So this is not a big deal. Just make sure that you get it, bring it to my attention. So today we're going to talk about growth and terminal value, the kind of final pieces of the puzzle. We talked about discount rates. We talked about cash flows. We're in the middle of growth. Today we finish growth. And we get to the elephant in the room. And the reason I call it the elephant in the room is you can do incredibly good work estimating cash flows and discount rates. But if you're sloppy about the way you estimate terminal value, you can wipe out all the work you've done. So today we're going to put some guardrails on terminal value so that you don't screw up, that it doesn't run away with your valuation. So kind of prepare for that terminal value section. I have a few questions that kind of lead into today's discussion. Lots of different ways of estimating terminal value. I'll throw out a few. One of these doesn't belong. I want to tell me the one way you cannot estimate terminal value. The others are all okay. So here are the potential ways you can estimate terminal value in a valuation. The first is to do a liquidation value. You run your company for 5, 10 years, you liquidate the assets, you get whatever you get in liquidation. The second is to use a stable growth model, which is what you see in most DCFs. Assume a growth rate in perpetuity after year 5 or 10. To come up with the terminal value. The third is to use what's called a growing annuity. You don't see it very often, but you get to year 10, but you say, I'm not comfortable assuming forever for this company. I'm going to assume 15 more years of growing cash flows, and then the company ends. It's a growing annuity. And the fourth is what's called an exit multiple, where you take your earnings or revenues or book value in year 10, you apply a multiple to it to come up with terminal value. What's a one way? If you're doing an intrinsic valuation, it's truly a discounted cash flow valuation. Which of these 4 is off the table? I heard exit multiple. You know why that should scare you? 80% of banking DCFs, if you look at the terminal value, we'll play this little game of 6 times EBITDA, 8 times EBITDA. It's a one way you cannot estimate terminal value. You know why, right? Where do you get the multiple? By looking at publicly traded companies in that space. It's a pricing. You made your biggest, these are kabuki DCFs. You're going through the pretense of, I'm doing a DCF, Look at my cash flows, and while I'm distracted, you slip in 10 times EBITDA or 8 times EBITDA. Liquidation value is perfectly okay. I use it often with private businesses where the owner is a key part of the business. You see why using a liquidation value makes sense? You're valuing a doctor's practice, or you're valuing a plumber's business. The plumber is 63 years old. It's kind of silly to put a perpetual growth rate in this business because it's tied to that person. So the end of 12 years or 15 years, you say, look, I'm going to shut the business down, and this is what I will get if I liquidate the asset. So liquidation value is the cash flow. It's completely consistent with DCF. Stable growth rate, obviously, we use it all the time, but a growing annuity is something I think we need to think about using more. Now, remember that life cycle structure I gave you, and I told you about tech companies having compressed life cycles? If you're valuing an Uber or an Airbnb, you might think this is a great company, but assume that tech companies last forever seems to be stretching the limit. These companies soar very quickly, but they very quickly kind of go into nothing. So maybe a growing annuity is what we should think about to get terminal values for tech companies. So we'll talk more about that. Let's move forward. Let's talk about estimating terminal. Let's start easy. Let's suppose you're trying to estimate the terminal value for a company. You get to year 10. Your after tax, so you have $100 million in after tax operating income in year 10. The company is expecting no growth, has a cost of capital of 10%. I've given you after tax operating income. I've told you the company has no growth, and I've given you a cost of capital of 10%. Looks like I haven't given you enough information for a terminal value, right? What's missing? Or I haven't given you net capex, change in working capital. Why do you not need it in this problem? What's the indirect, so what's the data item I give you that makes it unnecessary for me to give you net capex and change in working capital?
You don't have growth.
Basically, if your growth is zero, you don't need to reinvest money. You just have to maintain it. Doesn't mean you don't reinvest. You just have to reinvest enough to maintain your assets, right? So when the growth rate is zero, your reinvestment is zero. If your reinvestment is zero, your free cash flow to the firm is going to be 100 million because you're keeping the entire after-tax operating income. Your cost of capital is 10%. Your terminal value is therefore 100 million divided by 0.1 is $1 billion, right? Now let's play a little game. And this is the game that gets analysts into trouble. Let's assume I put a 2% growth rate in earnings at this company. Will my terminal value go up, go down, be unchanged? Could anything happen? So you see my question, it's the same $100 million after-tax operating income, but now I'm putting in growth, right? That's a good thing. But when I put in growth, what else do I need to bring into this calculation to make it realistic? I need to reinvest, right? In my original assumption, when I had no growth, I could say, look, there's no reinvestment. After-tax operating income, free cash flow to the firm are the same. But once I put in growth, I can't do that anymore. I've got to estimate how much I will reinvest. You're saying, how would I know that? Oh, remember that fundamental growth equation you talked about? Growth is equal to return on capital times reinvestment rate. In this case, I gave you the growth rate of 2%. If I told you the return on capital at this company is 10%, you know what you'll have to reinvest? To get a 2% growth rate with a 10% return on capital, you need to reinvest 20%, 2 divided by 10, which means your cash flow now, instead of being 100 million, will be 80 million. And what's going to be in the denominator? Since you have 2% growth, 0.10 minus 0.02. Here's magic. I put in a 2% growth rate and my terminal value stays exactly at $1 billion. Try it out. Put in 3% growth, 1% growth, 5% growth. Your terminal value will not change as your growth rate changes. You've already dispelled one argument that people use on terminal value, which is I can make the number any number I want by changing the growth rate. That's happening because you're changing the growth rate and leaving everything else unchanged. When you change the growth rate, you have to think about what does it mean in terms of cash flows. So today we're going to focus on that assumption about reinvestment in steady state and how to keep it consistent with what you're assuming about your company. So let's go back to where we left off on growth. And And now, obviously, we'll come back and talk a lot more about terminal value. So stop my share. So last session, we were talking about the growth in earnings per share for a company, right? You remember what the equation was? Retention ratio times return on equity. And I told you that in the long term, earnings per share growth is capped at your return on equity. So the higher your return on equity, the higher your potential growth rate. Let's take that to the next step. Let's think about how companies end up with high returns on equity. One, obviously, is by taking great projects. The Apples, the Googles of the world get great returns on equity, 30, 35, 40% returns on equity. That's one way to get a great return on equity. Here's the other way you can get a high return on equity. You can take average projects and lever up. Let me explain. Anybody in real estate knows that the way you pump up returns on equity is by using a lot of debt. And here's why debt can push up your return on equity. When you borrow money, obviously you have to pay an interest rate on the debt. You do get a tax advantage, so you pay the after-tax interest rate on the debt. So let's say you borrow money after tax at 3%. Let's say you invest in projects that make 8%. Doesn't sound like very much, right? 8%. But when you borrow money at 3%, you invest in projects that make 8%, you as the equity investor claim the difference. That's a leverage benefit. So if you look at the return equity, you can actually break it down into two parts. The first is the return on capital. Think of that as a return on equity you'd have had if you'd been an all equity funded company. So you'd stop right there. But to the extent that you borrow money, I'm going to measure how much you borrow with the debt to equity ratio. Obviously, the more you borrow, the higher that number is going to be. And then I'm going to measure the benefits of borrowing by looking at the difference between what you make on your projects and your after-tax cost of debt. You can already see that if I use enough debt, I can take average projects and make the return on equity go through the ceiling. So let's take a couple of examples on two ends of the spectrum. The first is a very old assessment I did of a company that used to be called Brahma. It's now called Ambev. Now it's become a very different brewery. But at that time, Brahma was a Brazilian brewery. When I first looked at it, I was impressed by its return equity. It's about 31%. So I want to know, what is it doing that's allowing it to earn a 31% return equity? Well, first, it is taking projects that make a pretty high return, 19.91%. If they'd been entirely equity funded, the return equity would have been 19.91% as well. But here's what they did that magnified the return equity. For every dollar of equity they had, they borrowed 77 cents. They paid about 5.61% after taxes on that debt. At that time, Brazilian companies were borrowing money at pretty high rates, but 5.6% after taxes. Think about it. You're making 19.9% of your projects, you pay 5.6%. That difference of 14.3% is accruing to the equity investors. Every dollar you borrow pushes up your return equity. That 31% return equity, 12%. So in fact, I'm decomposing the return equity and saying, this is how much comes from great projects, and this is how much comes from the use of debt. So when you look at your company and you see an impressive return equity, break it down, saying, why does it matter? Returns on equity from good projects are pure value creators. When you make a 25% return equity, I'm celebrating because you took great projects. But when you push up your return equity using debt, it's a mixed blessing, right? My growth in earnings per share goes up because I have a higher return equity. But this is like the free cash flow equity story. I'm looking at growth in earnings per share. That's an equity earnings. The discount rate I should be applying is a cost of equity. And now the same debt that pushes up my return equity is also going to push up my cost of equity. What real estate developers hope you do when they hit you with the return equity, return equity is 25%, is they hope you compare to an absolute number. Well, that's much better than 9% I'm making on stocks. But remember, we had 95% debt, and that's why return equity is at 25%. What you should be judging that 25% return equity against is a cost of equity that reflects that leverage. Same thing with PE investors, right? If you're a PE investor, you do a lot of leverage buyouts, your return equity is going to be impressive. When Blackstone went public, I remember analysts being impressed by the 26 or 28% return equity it had. And nobody dug in and asked the question, how much leverage are they using to get this 26 or 28% return equity? Any questions on the leverage effect on return equity? Now, will leverage always help you as an equity investor? What's a necessary condition for leverage to push up your return equity? I'm not even talking about the value of equity. To push up your return equity, what's a necessary? Take a look at the equation. What's necessary condition? My cost of debt after taxes has to be less than my return on capital, right? It's a minimalist condition. It's not even a value creating condition to make your return equity go up. Now, I grew up in a city called Chennai in India, and I don't go back very often. I've been gone for 40 something years, so I don't have that many connections. But I do go back to visit my parents and my brother and sister who still live there. And somehow people get wind of the fact that I'm coming, and I get all kinds of invitations from corporates. Can you come in and talk to us? Most of the time, I say, look, and I come to, but once in a while you get an invitation from somebody you've known for a long time. So remember about 30 years ago, a very long time ago, I went back and I had an invitation from an Indian company called Titan Watches. It's a well-regarded Indian company. It was part of the Tata Group, one of the smaller parts. And I knew the people on the board of the company because many of them I'd grown up with. And the person who contacted me said, look, we're trying something at Titan. It doesn't seem to be working for us. And I said, what are you trying? He said, we were trying to use more debt to pump up return on equity, but every time we borrow money, our return equity seems to go down. So I said, I'll take a look. So you can see very quickly, once you take a look, why it's not working for them. The return on capital is 9.54%. So if they had borrowed nothing, the return equity would also be 9.54%. This was 25 years ago. It's all done in Indian rupees. The government bond rate was like 13%. The cost of debt was 10.125%. You borrow money at 10.125%. You take projects that make 9.54%. Every time you borrow money, guess what's going to happen? Your return equity is going to decrease. I describe debt as a double-edged sword. In good times, it's going to pump up your return equity. But remember, there will be bad times. And when there are bad times, the same factor will start to work against you because now you're paying more on debt than you're getting in as a return on capital in your projects. So when people talk about, I've added value by adding debt, be very skeptical. It's really difficult to create value by just pumping up the debt in your company. But unfortunately, a lot of restructuring, especially the last 30 years in the US, has become all about playing with the debt and equity mix in a company. I'm not saying it can't create value. We'll talk about the ways, but it creates far less value than people realize because often their comparisons are based on what kind of return equity you make and comparing it to some old cost of equity that doesn't reflect the leverage. So that's growth in earnings per share, retention ratio times return equity. And remember, retention ratio is an easy number to get, but it's capped at 100%, can't be greater than 100%, and floored at 0%. So let's now expand this equation to think about what the growth would be, not in earnings per share, but in net income. In fact, not even all net income. Let's focus on net income from just operating assets. You're saying as opposed to what? Remember, in net income, you also have income from cash and marketable securities. Let's take them out of the mix. They're a distraction. If I ask you, what's the growth in net income from operating assets? The way we think about how much you reinvest and how well you reinvest is going to change. Rather than focus on the retention ratio, we assume that whatever doesn't get paid out in dividends gets reinvested. When you're looking at reinvestment, I'm going to look at what you actually reinvest, which is net capex plus change in working capital. So not everything that gets retained gets reinvested. I focus on what gets reinvested. And because I'm an equity investor, I net out the effect of debt. So if only if I have to come up with only 80% of that reinvestment, that's what I count as my equity reinvestment. If that looks familiar, that's the equation we used when we used the shortcut to get to free cash flow equity. We took the reinvestment times 1 minus the debt ratio. So in the numerator, I'm looking at the equity portion of what I reinvested. In the denominator, I'm going to look at the net income, but only from non-cash assets, which means I'm going to take the net income and subtract out from it the income I made from cash and marketable securities. I'm going to come up with an equity reinvestment rate. Very similar to retention ratio, but much more focused. But when I do an equity reinvestment rate, I also relax the caps and the floors. What's the highest number an equity reinvestment rate can be? It's not capped at 100%. I can reinvest more than 100% by doing what? Raising fresh equity. It's not floored at 0%. I might choose not to reinvest money. In fact, I might have depreciation come in and not put in any money in CapEx. Equity reinvestment rates can be greater than 100% or lower than 0%, which is a good thing to have because there are some companies whose net income can grow much faster than earnings per share because they're choosing to raise capital. And when I do non-cash return in equity, I'm going to take the net income from the non-cash assets, but rather than divide by book value of equity, I'm going to take out the cash because I want to focus on what they're making on their non-operating assets. I'm sorry, their operating assets. So let's try this. This is from a Coca-Cola calculation in 2010. In 2010, Coca-Cola had net income of $11.8 billion. Made a ton of money. Their book value of equity was $25,346 million. So both of those came right out of the income statement and the balance sheet. They had a cash balance of $7.02 billion, and they earned an income of $105 million on that cash balance. Their net capex was $2.2 billion. Depreciation was $1.44 billion. So all these numbers are coming right out of the financial statements, and working capital went up by $335 million. Let's assume I'm trying to compute equity reinvestment rates, non-cash return equity, and growth rates. Let's start with equity reinvestment. 2.215 billion minus 1.44. That's my net capex right there. Plus change in working capital. Plus minus this, they paid off 150 million debt. So the equity reinvestment was 957 million. I'm focusing only on the portion that comes from equity. So to the extent that debt paid for some of this, I'm counting on only the portion that equity investors had to come up by. If you divide that by the net income net of cash, I get an equity reinvestment rate of 8.18%. If you're surprised by why it's that low, we'll come back and talk about what I might be missing in my reinvestment for that equity reinvestment rate. So they don't seem to be reinvesting very much, 8.18%. But if you look at the non-cash return equity, the non-cash return equity is sky high, 64%. The same forces that make my equity reinvestment rate low are also making my return on equity high. So if you multiply that low reinvestment rate by the sky high return equity, the growth rate I get is 5.22%. Mechanically, I think I've done everything right. But I think my equity reinvestment is artificially low because of something I've done that I perhaps could fix. And I'll give you a clue. When we talked about R&D, remember we talked about other expenditures that might be like R&D? And I think we talked in, especially in the context of consumer product companies, what one of those expenses might be, right? Marketing and advertising. You could argue that maybe half of Coca-Cola's advertising expenses have nothing to do with current year operations, but they're building up brand. If I capitalize those advertising expenses, tell me what's going to happen to my numbers. First, what will happen to my reinvestment? It's going to jump because now I'm going to bring in at least a portion of that brand name spending, right? Remember, you add back the R&D, subtract out the amortization. My equity reinvestment rate is going to be higher. What else is going to change? When I do my return on equity, what's going to be in the denominator? A book value of equity that includes the capital invested in our, so I'll have a higher reinvestment rate and a lower return equity. But I think, look, I might not get the same growth rate, but I'll get a more realistic assessment of what Coca-Cola is reinvesting and what it's actually making on its projects. That's why we capitalize R&D. That's exactly the impact you're going to have at a technology company when you capitalize the R&D. You're going to push up the reinvestment rate. You're going to push down the return. That product is still going to be the growth rate. It might not match what you thought was the growth rate before, but it'll be a more realistic assessment of what this company is doing. Any questions on non-cash return on equity or equity reinvestment rates? So we looked at growth in earnings per share. We looked at growth in non-cash net income. Let's close the loop by looking at growth in operating income. As we go through, notice that we're looking at the same question, but the way we're answering the questions is changing as we go from earnings per share to net income, and now we're going to operating income. When you're looking at operating income, when you look at how much is the company reinvesting, you now look at a reinvestment rate. You look at the total amount reinvested, not just the equity portion, but the total reinvestment, net capex and change in working capital. And instead of dividing by net income, you divide by after-tax operating income. Again, you're still being internally consistent. That's your reinvestment rate. When I ask you how well are you reinvesting, rather than give me return equity, you give me return on capital, which is operating income net of taxes. So it's after-tax operating income divided by book value of debt plus book value of equity minus cash. Reinvestment rate times return on capital is my expected growth in operating income. And just like equity reinvestment rates can be higher than 100%. If you're a high growth company that's reinvesting huge amounts and raising capital, they can be lower than 0% if you're a company that's choosing to shrink. You're a tobacco company, you've decided to become smaller over time. So again, you get more freedom with reinvestment rates than you do with retention ratios. So retention ratios, equity reinvestment rates, reinvestment rates. Return equity, non-cash return equity, return on capital. Don't think of them as separate equations. Think of them as different ways of answering the same question. So let's try this. Again, I'm going to go back in time, and there's a reason I'm going to go back in time. 1999, peak dot-com boom. Cisco is one of the stars in the investment universe. Its reinvestment rate was 107%. What does that tell you? Cisco's doing a lot of acquisitions. They're reinvesting far more than their operating income. But what is even more impressive was while they were reinvesting this huge amount, they were earning a 34% return on capital. Usually when companies reinvest huge amounts, the return on capital drops off, right? Because as you take more and more projects, but they were able to keep both a high reinvestment rate and a high return on capital. How does this play out? If I assume, and it's a big assumption, that they can maintain these numbers, their expected growth rate is going to be about 36% a year. High reinvestment rate times high return on capital gives you a high growth. In contrast, in the same year, Motorola's reinvestment rate was about 53%, not bad. Its return on capital is 12.18%, not bad. But if I multiply not bad by not bad, I get not bad. The growth rate I'm going to get for Motorola is 6.45%. When you dig deeper and look at why some companies are able to maintain these really high growth rates for long periods and others are not, the answer is always going to lie in what are they reinvesting and how well are they reinvesting. Motorola cannot grow at 35% a year as long as the return on capital stays floored at about 12%. Now, of course, with Cisco, I actually did my valuation with this and I overestimated value. You know why? What am I implicitly assuming there? That they can keep doing what they're doing in 99, reinvesting 106%, making a 34% return on capital. And in the next decade, when you get past the 90s, look at 2000 to 2009, Cisco kept reinvesting. Their reinvestment rate stayed at 90, 100, 105%. That part of the equation stayed stable. But the returns on capital dropped off from 34% down to 20 and 15. Not bad, but you can see the growth rates start to reflect the fact that the projects were no longer as good as the projects it took in the previous decade. So with all of the equations I've shown you, retention rate times return on equity, non-cash return on equity times equity reinvestment rate, reinvestment rate times return on capital, I'm assuming that a company has reached steady state, that the margins and returns on capital can stay stable over time. You know, when that works for about 10% of companies. Very few companies have reached that steady state. So, but in all of these numbers, if you look at it, the key to driving growth is either return on equity or return on invested capital. And that number terrifies me. And I'll tell you why it terrifies me. If you look at that number, it's after-tax operating income in the numerator, which is an accounting number. And what's in the denominator? Book value of equity plus book value of debt minus cash, which is also an accounting number. I am completely at the mercy of accountants when I compute return on capital. And that's stating a fact. And how does this play out? Everything that accountants do to screw up book values will also screw up my return on capital. to the start of every year when I do this for all 46,000 publicly traded companies, I try to do the cleaning up for leases and R&D because that I can clean up. But there are other things I cannot clean up. And I'll give you a few examples. When companies make mistakes and everybody realizes they've made a mistake, what are accountants allowed to do? So let's say you're Chevron, you invested 6 years ago in a project in Russia, and now you decided the project is no longer viable. You're allowed to write off the project, right? You're saying that's good, that's sensible. You're right, it's good. But when accountants write off something, it's a restructuring charge or a write-off charge, what happens to your book value the year that they do the write-off? It's going to go down. The year that it happens, you can see why it happened. But let's say it's 3 years later, you're looking at this company, you're computing the return on capital for this company. The return on capital can look awesome because you're dividing by a low book value. But what you're not factoring in is it looks great because you took your mistakes off. If I let you take your mistakes off the books, you're going to always report a great return on capital, not because you have great projects, but your mistakes disappear. The long-winded way I'm saying, you can compute the return on capital of your company, and I'd strongly recommend you do it, but also look over time to see if there's something that's skewing that number up or down. Because for some of you get outlandishly high returns on capital for companies which have had big write-offs, which have had buybacks, because your book value shrinks and your return on capital blows through the roof. Now, I don't know whether any of you have trouble sleeping, but if you do, I have a solution. It's a paper on estimating return equity and return invested capital. It's 65 pages. I mean, I fell asleep multiple times while I was writing the paper. It was that boring. But it's about all the things you need to fix to get a return on capital that's good. Things like reversing restructuring charges. What do you do with goodwill? Things that are absolutely tedious. But return capital has taken on this life of its own in consulting firms. There are consulting firms and people going, what's your ROIC? And you have no idea what they're talking about, which is deliberate because they don't want you to know what a ROIC is. But when they talk about ROIC, they're talking about return on invested capital as if it's the answer to every prayer. Which brings me to my fourth scenario. I told you that these sustainable growth equations I showed you work as long as your returns on capital are stable. But let's say you have a company where you look at the return on capital and you say, I think the return on capital of this company is going to go up over time. Why? Because they're getting economies of scale, or go down over time. Why? Because competition is coming in. Say, what is that going to do to my growth? Let's work out the math. When you have the return on capital changing, you're going to get a second dimension on your growth rate. And to see why, let's suppose you have a company with a 5% return on capital. It reinvests nothing. And I think we did a test at the start of the class, not last class, to see you have a 5% return on capital, it reinvests nothing. And ask you what's your growth rate going to be. If you put it into the sustainable growth equation, you say 5 times 0% is 0. I now tell you, look, I think the return on capital of this company is going to double next year. They found these inefficiencies, they're going to eliminate them. The return on capital is going to go from 5 to 10%. They're still going to reinvest nothing. Mathematically, what's their growth rate going to be next year if their return on capital goes from 5% to 10% and they're reinvesting nothing? Let's put in the numbers. You have $1 billion in invested capital. Right now, you're making 50 million, right? 5%. Next year, you're going to make 100 million, which is 10%. 50 million to 100 million is 100% growth rate. That's called efficiency growth. Every time your return on capital goes up, it gives you that boost in your growth rate. Conversely, every time your return on capital slides down, it's pulling down your growth rate as well. And it can make a big difference over time. Remember that Motorola example that I showed you, the growth rate of 6%? At the time that I valued Motorola, I made an assumption that it'd be able to improve its return on capital from 12% to 17.5%, which was the industry average. I did assume that this improvement would happen not just next year, but over the next 5 years. Think about it, they reinvest nothing, improving your return on capital from 12% to 17.5% is going to increase earnings by about 50%, right? Basically, it's just going from 12 to 17.5. So here's how it plays out in the annual growth rate. If they have no improvement, you can just say, look, on the new projects, I make 17.22%. That's my target return on capital times the reinvestment rate, my growth rate will be 17.29 times 16.29%. In other words, my growth rate is going to be about 8% or 8.5%. But because I'm improving my return on capital over the next 5 years, this just looks fancy, but it's just a compounding of the growth rate. You can divide by 5 if you want an approximation. My actual growth rate for the next 5 years will be about 16%, double what I got from just looking at reinvestment times return on capital, because I expect this company to improve its return on capital. I know some of you are valuing companies with terrible returns on capital, infrastructure companies, steel companies. And that's a bad thing, right? You take that low return on capital, you multiply by the reinvestment rate, you get almost no growth. I'm giving you an opening for this company's return on capital to improve over time. And if that happens, you're going to get additional growth coming from that improvement. So conversely, if you're doing a company with a 50% return on capital, watch out for the fact that that return on capital can go only one direction. It's not going up. It's probably going to come down. And when it comes down, it's going to push your growth rate down. So sustainable growth equations are neat. I use them for terminal value calculations, but there are very few companies where I assume the growth for the next 10 years is just going to be return on capital times reinvestment rate. Why? Because margins change, returns change. And if that's happening, you got to be careful not to apply the sustainable growth equations. So let's bring this all together, because we've all been taught that growth is good and to treat all growth as if it's equivalent. I'm going to show you 5 companies, all of which have exactly the same growth rate. But the way they get that growth rate is very different. Company 1 has a reinvestment rate of 20% and a return on capital of 50%. 20% times 50% is 10%. Company 2 has a reinvestment rate of 100% and a return capital of 10%. Still 100% times 10% is also a 10% growth rate. Company 3 has a reinvestment rate of 200% and a return on capital of 5%. Let's pause right there. I've got 3 companies, all have 10% growth rates, but the way they got there was very different combinations of returns on capital and reinvestment rate. If I just take firms 1 through 3, they all have the same growth rate, but which of those 3 companies is creating the most value from growth and why? But company 1 is the most value creating. Why? Because it's taking great projects, which means they can afford to return a lot of cash and grow at 10%. Company 3 is growing at 10%, but it's diluting your equity like crazy and trying to grow. It's actually destroying value as it grows. When you look at the growth for a company, before you get too impressed by the level of that growth rate, dig to see how it got that growth rate. Did it get it by going out and doing big acquisitions and lots of projects, or did it do it by taking projects and just running them so efficiently it was able to deliver 30, 40, 50% returns on capital? The last 2 firms, you can see that the growth rate comes from both reinvestment and the fact that they're efficient. The nice thing about efficiency growth, it's like icing on the cake. You're really not working for it. The bad thing about efficiency growth is it can't last forever. You can't assume a company can improve its returns on capital every year in perpetuity. So all I'm suggesting from this section is dig behind the growth rate to see why a company has the growth rate that it does. Because there are good ways of growing and bad ways of growing, and you want to make sure your company has chosen the right path. So I'm going to close this section with my most generic way of thinking about growth. I'll tell you, I call it generic because it'll work for any company. This is an approach that you give me young money-losing companies, mature companies, or declining companies. This approach will work for all of them. And to see what I'm going to do here, I'm going to break down my estimation into 3 steps. Those of you who've seen my spreadsheet see this breakdown play out. You asked me to value a company. Here's what I'm going to do. I'm first going to project growth in revenues, not earnings or operating income, because the margins could change. So I'm going to start with growth in revenues. What's going to drive that growth rate is how big you are as a company, how big the potential market is, and what market share I think you will adopt. So a very general question about, are you a small company in a big market or a big company in a mature market? That's revenue growth. The second piece of the puzzle is I'm going to ask you what's going to happen to your margins over time. So right now you could be a money-losing company with negative margins. The question I'm asking is, where will those margins end up? I'm not saying it's an easy question to answer, But if you're a software company, your margins could end up at 35%. If you're a manufacturing company, it could end up at 15%. So the second step, I'm estimating margins. So I've got revenue growth that makes my small revenues into big revenues. I've got margins changing. Then I ask a third question to apply closure. When you told me you wanted high revenue growth, I went along. But now I'm going to come back with the bill and say, if you want to grow your revenues, how much will you need to reinvest to get that revenue growth? And to compute how much you're going to reinvest, I'm going to look at how many dollars of revenues you get for every dollar of capital you invest. The higher that number, the more efficiently you're generating growth. It's called a sales to capital ratio, but it becomes a proxy for, are you a company that delivers growth efficiently or not? Revenue growth, margins, sales to capital. You give me those three numbers, I can move the world. I can basically take any business and boil it down to basics. To see why the three numbers are kind of interconnected. Let's assume you decide to be a high growth business that sells at a low price. Basically, you're going to go for a high market share. So let's go through the inputs. Your revenue growth obviously is going to be high because you've gone for the growth. But because you've decided to go for low prices, that's going to go with low margins. Doesn't make it bad. Walmart, for instance, has margins that are paper thin. But it makes up for those paper thin margins by having huge scaling, huge revenues. So when you look at business models, you're trying to capture the business model with those three parameters: revenue growth, margins, and sales to capital ratios. So I'll take a recent example. Now, 2020, as you well know, Airbnb decided to go public. In fact, its timing surprised people, right? It was in November of 2020. The world had been shut down. So why would you go public now? And there's actually a good reason. They actually became stronger relative to their competition during COVID, because COVID basically handicapped and broke the kneecaps of Marriott and Hilton and all the other traditional competitors. So I did a valuation at the time of the IPO. And here I had to do a top-down, right? It was a money-losing company with lots of potential. So I'm going to lead you at least through a piece of this process. Again, later on, we'll come back and do the entire valuation. I'm going to take you through the growth, margins, cash flow part of the process. First, if you look at Airbnb, and you all use Airbnb, the way they make money is they're an intermediary. So when you book an Airbnb and you pay $500, they keep a slice of that $500. That slice right now is about 14%. It's about 12.5% to 14% because they collect from both sides. Now I think it's primarily from the apartment owner, but it's about 12.5% to 14%. It's a pure intermediary business. So to project out revenues for Airbnb, I started by projecting gross bookings. Now, when you sit down to value a company, this is a question you say, how do I know what the gross bookings will look like? I look for clues. I look for other companies in this business and what would big revenues look like in this business? Because without answering this question, I really can't value Airbnb. And there are two companies out there, Expedia and Booking.com, that can be considered to be players in the space. They're both intermediaries. You think, why don't you compare Airbnb to a hotel company like Hilton? It's not really a hotel company, right? Hotel companies have a very different combination of revenue growth, margins, and reinvestment than a booking company. In fact, the company that Airbnb is probably closest to is Booking.com. Its gross bookings in 2019 were about $96 billion. Collectively, the revenues for all hotel companies about $750 billion. Booking.com is already a pretty big player. I'm going to assume in my story, and we're going to talk about why stories matter here, that Airbnb will become bigger than Booking.com. Why? Because it's bringing in, Booking.com is still a very traditional hotel booking company, airline. So Airbnb can bring in new business into the space and may perhaps expand the market. So my gross bookings over time go from 26 billion to 155 billion. That's a pretty upbeat story, right? I'm making this company into the largest travel company in the world. Bigger than any hotel, bigger than any other booking company out there. The percentage that they will keep as revenues are pretty, they don't change that much. It started about 13, ended up at 14. The reason I pushed it up is Airbnb actually deliberately changed its business model at the time of the IPO. It used to collect money from both sides of the transaction, 6.5 from the owner, 6.5 from the, they changed the model to make it a much more direct model and also a model where they could collect. a greater percentage, 14%. So as I go through time, my revenues are moving towards 14% of my gross bookings. My revenue growth is just a computed number. Basically, it's just a number that gets me from where I am today to where I'd like to be. So this is not a valuation where I said, what's the growth rate going to be in year 1, year 2, year 3? Because I need to get a sense of what the end revenues are to figure out what the growth rate will be. As a general rule, when you value young companies, don't get too focused on percentage growth rates in year 1, year 2, year 3. It's a distraction. What you want to think about is how big am I making this company over time? And is that something I can sustain with the story I'm telling about this company? And finally, if you look at the operating margin, they start with a loss. Why? Because they're losing money. And I don't expect them to turn that around quickly. But over time, I expect the margins to converge on 25%. Here again, if this were a hotel company, you know what those margins would look like? Probably 11%, 12%. Hotel companies don't make great margins. It's a business. You have lots of costs in running a hotel. But if you're an intermediary, your margins can be much higher. In fact, the 25% puts, if you look at booking at less than booking.com. But booking.com has margins that go up and down, and it's much higher than what Expedia has as margins. So I'm aiming for a number between those two numbers as my end margins. So I'm making the company bigger. I'm pushing its margins from negative to positive. On my spreadsheet, I've taken this young money-losing company and made it into a large money-making company. There's a story I'm telling. It's a pretty upbeat story of a company that's going to change the travel business, make it bigger, and end up dominating the business in terms of market share. The reason I bring that all together is when I look at when I did the final piece here, I had to estimate how much they would reinvest. Now, normally you think about net capex and change it. You drive yourself crazy if you try to estimate those line items for a young company because you have no idea how they're going to grow. They have no idea how they're going to grow. So what I did to get the reinvestment was I assumed that they'd get $2 of revenues for every dollar of capital. I got that again by looking at booking.com and Expedia. When you value young companies, you have to get frames of reference that come from outside the company. Looking at its historical data is not going to give you much of a frame of reference. That sales capital of 2 basically means that every year I compute the change in sales. I take the change in sales and divide by 2, and there's my reinvestment. Very simplistic. But when you're valuing young companies, you want to keep things simple. You break things down into more detail, you're very quickly going to lose control of the valuation. I know it's not a complete valuation, but this is the heart of the valuation. And in this upbeat story I'm telling about Airbnb, take a look at what my free cash flows look like for the next 6 years. This is my upbeat story. My free cash flows are negative for the next 6 years. Why? Because I'm so ambitious with this company. I'm expecting it to grow. It's because I'm optimistic about future growth that my free cash flows are negative. If you go to my blog, you'll see the end valuation that I got for Airbnb with this upbeat story. The value that I got was about half of what the market price was when it went public. Does it mean the market is wrong? Absolutely not. It could be that I'm missing some part of the story, but I'll challenge you. This is what you need to think about. What would need to change it? Because you got only 3 levers, right? Revenue growth, margins, and reinvestment. One of those 3 levers has to change. The reinvestment does very little. So it's got to be either that you see even more revenues than 155 billion at the end of year 10. Maybe you see a story where Airbnb has 300 billion revenues. Or maybe you see margins being much higher than 25%. Everything in this value goes down to those 3 inputs. Any questions about top-down growth? If you get a chance and go back and revisit almost every valuation I've sent as a valuation of the week, they're all built around the structure: revenue growth, margins, and reinvestment. Take a look at the Tesla valuation. It's all driven by what I think, how big I think Tesla can be in 10 years as an automobile company. What kind of margins it can deliver? Is it margins closer to technology company or an automobile company? And how efficiently can Tesla make these cars? It's going to go into reinvestment. You're trying to answer basic business questions using these 3 parameters. So let's talk about terminal value. Now let's talk about why we need terminal value in the first place. We've got a math problem. Here's what the math problem is. The value of an asset is the present value, the expected cash flows in the asset over its lifetime. And at least in theory, a publicly traded firm can go on forever. So we need terminal value because without it, we're going to be estimating cash flows in year 155, 156, 157, and none of us has the patience or the capacity to do it. So terminal value is just a way of stopping and saying, I can't estimate cash flows anymore, but this is what I think my company will be worth at the end of year 5, or the end of year 10, or the end of year 15. So with that structure, let's talk about the different ways you can estimate terminal value. I've kind of given away the answer already, but there are 3 broad ways in which people estimate terminal value. One was liquidation value. In fact, when we do capital budgeting, remember capital budgeting is a subset of valuation. We project out, a project's cash flows the next 10 or 15 years, and we salvage the project. We end the project, we sell off the assets, we get liquidation value. You don't use that as often in valuing businesses, but as I said, with private businesses, especially if there's a key person involved, I don't think it's unrealistic to assume a liquidation value. The second is to use a stable growth model. And I'm going to talk more about that because that's what you see in most DCFs. The third, and this is the approach that I said should never be used, is to use a multiple, because then you're making the biggest number in your DCF into a pricing. So let's talk about that stable growth model, because there are so many misconceptions about that model. They terrify me. So let's say you've got to that year 5 or 10, you're getting ready to use the stable growth model. The stable growth model basically says you take the cash flows in year 11 or years. So it's always 1 year after your end year. That's a mathematical requirement because all present value equations require cash flow 1 year out. So let's say you want a terminal value in year 10, you need cash flows in year 11 divided by R minus G. You're saying what R? Depends on whether you're valuing equity or the firm. If you're valuing equity, it'll be the cost of equity. If you're valuing the firm, it'll be the cost of capital. And you subtract out a G from it, a growth rate, R minus G. Take a look at that denominator. You can already see why terminal value, if you're not careful, can implode on you, because as G moves towards R, your terminal value is going to become infinity and then beyond. And that's what drives people a little crazy. They say, but I can play with the G. The key word is you're playing with the G. So what I'm going to do right now is introduce some constraints on what you can and cannot use as growth rate in perpetuity and what has to change when your growth rate changes. Before I do that, there are a couple of things about that growth rate forever that we need to kind of nail down before we talk about how to estimate. The first is that growth rate cannot exceed the growth rate of the economy in which you operate. I don't care who you are as a company, what kind of company. And the reason is very simple. It's a mathematical reason. Remember, this is forever. If I let a company grow at a rate that exceeds the growth rate of the economy forever, take 2 numbers in a spreadsheet. One is smaller than the other, but let the smaller number grow at a higher rate than the larger number. Eventually, the smaller number is going to overtake the larger number. Then what? So that's almost a constraint. It's got nothing to do with valuation or finance. No company can have a growth rate in perpetuity that exceeds the growth rate of the economy. You're saying, how do I know what that is? We'll talk about ways you can estimate, but that's your cap. But that's a cap. Most companies, which are mature companies, will grow at a rate less than the cap. So if you think the growth of the economy is 2%, most mature companies will have to grow at a rate less than 2%. And here's why. If every mature company grows at the same rate as the economy, then where do growth companies go? That economy will have no space for growth companies. So we have both growth companies and mature companies in an economy. Almost by definition, the mature companies must be growing at a rate less than the cap. So what I'm trying to say is if you decide the growth rate of the economy is 3%, don't make every company value have a growth rate of 3%. Some companies might grow at 2, some will grow at 1, some might have 0% growth. Is it possible that some companies could have a minus 5% growth forever? Absolutely, why not? Because if you do that, what have you done to your company? You peak in year 10 and then your company gets smaller and disappears, which is actually closer to what actual life cycles look like in practice. Leave open that possibility that there are some companies who put a negative growth rate in perpetuity. What kinds of companies might you be valuing today? We put a negative growth rate in perpetuity. But give me a sector where this is going, you're going to run into this. Retail, but be careful, brick and mortar retail, you're valuing a Bed Bath and Beyond. Today, there's a whole lot of excitement because some GameStop guy is taking a position. Of course, the meme stocks are coming, but the reality is there's no uplifting ending for Bed Bath and Beyond. That place is an absolutely depressing hello to shop in, and it's not going to get less depressing over time. It's, so when you value Bed Bath and Beyond, you might say, my growth, I'm going to give them 5% growth for the next 5 years because they can figure things out. But after year 5, I'm going to put in a minus 3% growth rate in perpetuity to make them disappear. G is well past that. So so that's not even a question. It's a question of how negative to make the growth rate and how quickly to make it disappear. How about fossil fuel companies? You're valuing Exxon Mobil or Royal Dutch. I know right now oil price of $130 a barrel. You might be upbeat about their earnings, but the reality is, I might not be much of a believer in ESG and how it's sold, but climate change is real and fossil fuel companies will come under increasing pressure. Some of them might go into green energy, but the reality is valuing a fossil fuel company, you might put in a negative growth rate in perpetuity. In fact, isn't that the essence of disruption? Disruption, we talk about the exciting side, right? The disruptors. We talk about the Ubers, the Airbnbs. But remember, there's a dark side to disruption. When you say Uber is going to have a 30% market share, if you're valuing a taxi cab company, you're talking about a negative growth rate in that company. So leave open that possibility that your growth rate can actually be negative for some companies. Yeah.
Does that mean that any company that uses an input that is finite should just have eventually negative?
Potentially, unless they can find a new business to be in. So if you notice that oil companies no longer call themselves oil companies. They call themselves energy companies. That way you say, you know what, when you run out of oil, we'll figure whatever else you get energy from, because that's going to be a growing resource. But any mining company, you got to be careful about putting in a positive growth rate in perpetuity because you're going to run out of that resource if that's all you do. Now, of course, the question then is, what is that cap? Because I said it's a growth rate of the economy. Saying, how are we going to estimate it? I've kind of given you a clue, right? Because when we did implied equity risk premiums, and I got to year 5, I'd say it's the same question. What's a growth rate I should use forever? And what did I use as my proxy for the growth rate forever? I used my risk-free rate. I'm going to use that same proxy here. I'm going to say, you get to year 10, you ask me, what is my growth rate going to be forever? I'm going to tie it to the risk-free rate. And this is perhaps the most controversial thing I do. I get the most pushback on this. So I'm going to defend why I use the risk-free rate as my proxy for the growth. You know why I get pushback, right? Because if I use that proxy right now, what's your growth rate in perpetuity going to look like for any valuation you're doing in US dollars? What's a cap going to be? It's going to be like 1.9%. What's a T-bond rate? 1.8%. If I'm valuing a company in euros, it gets even worse, right? You have a negative risk-free rate, I'm actually going to cap you at minus 0.5%. So when people see that, they say, but that's so pessimistic. Is it though? You didn't complain when I gave you a 0.5% risk-free rate and gave you a low cost of capital. Magically, you're complaining when I use that same low risk-free rate to give you. One reason I would argue for tying the growth rate to the risk-free rate is no matter what you think about the risk-free rate, at least you're being consistent. So if you think the risk-free rate is artificially low, then I'm on your side. I'm saying, okay, let's keep it artificially low. Let's leave it there. Your cost of capital is artificially low, but your growth rate also needs to be artificially low. The strongest argument for tying the growth rate to the risk-free rate is it keeps your valuations internally consistent. And if you adopt this, low risk-free rates can't make your valuation go through the roof, right? Because when you have low risk-free rates, it comes with this catch of your growth rates are also going to be low. But I'll give you more empirical backing for why I think the growth rate, the risk-free rate is a good proxy for the nominal growth rate. If you go back the last 50 years, there are lots of economic services and macroeconomists who forecast growth in the US economy for the long term. In fact, there's a study that looked at these forecasts of growth that come from economists and compared them to a much more simplistic way of forecasting growth, which look at the T-bond rate at the start of every decade. You know, the T-bond rate has consistently beaten consensus estimates from economists in terms of forecasting future growth. Take a look at this table. I've listed out the T-bond rate in each period and the inflation rate and the real GDP growth rate. This is that intrinsic risk-free rate equation graph that I showed you earlier in the class. If you look at why, when you look at the T-bond rate, you look at the inflation rate, you can see the two are tied together. They're not exactly equal, but you can see that when inflation rates and real GDP growth is low, as it was in the last decade, T-bond rates tend to be low. There's a Fed effect, obviously, at the margin. But my point is, when we talk about low risk-free rates, we have to think about what causes risk-free rates to be low and build it into our growth rates and cash flows. So my defense for using the risk-free rate as my growth rate in perpetuity is it keeps my valuations consistent. So one is too low, the other is also going to be too low. One is too high, the other is also going to be too high. And the second, historically, it's done a pretty good job of forecasting growth in the economy. Any questions?
Professor, I have a question.
Go ahead.
So, what if there are negative real rates for the economy?
Doesn't matter, right? Are you doing evaluation in real terms or nominal terms?
So, if it's in real terms, then
you have a negative real. How do risk-free rates turn? If you have real risk-free rates and they become negative, what is it telling you about the future growth in the economy?
perhaps it's going to be negative.
Exactly, right? If you look at the parts of the world, we have negative real risk-free rates and negative nominal risk-free rates. There tend to be parts of the world like Japan and Europe, where you have an aging population. And the market, in a sense, is building that into both risk-free rates as well as growth rates. So I have no qualms about using a negative growth rate in perpetuity if your risk-free rate is also negative. So it's a consistency argument. And basically what it allows me to do then is to tell you, look, I'm not taking a point of view on the T-bond rate. We could debate for the rest of this semester what the right T-bond rate should be. I don't have the time or the patience for that. I'm going to take the T-bond rate today as a given. Remember, I said, don't play with it, make that the basis for your cost of capital. And then I'm going to say, look, the other shoe that's waiting to drop is when you get to my perpetual growth, my growth rate will match my risk-free rate. And I gave you an out. If you feel risk-free rates will change over the next 10 years and you want to use a higher risk-free rate after year 10, then I'm going to let you use a higher growth rate as well. But I'm going to lock the two together. So in my spreadsheet, I give you that chance. I said, what will the T-bond rate be 10 years from now? You want to put in 5% there? I'll go along with a 5% growth rate in perpetuity, but guess what's going to happen? That 5% risk-free rate will push up your discount rate. What happens to one number should also happen to the other. So that's the first piece of advice I'd have for you is when you think about that growth rate forever, take a look at your risk-free rate, which means if you're working in a high inflation currency, the Turkish lira, you can have a growth rate of 10% forever, right? Because your risk-free rate is 11 or 12 or 13%. You're working in the Swiss francs, definitely can't put in a 10% growth rate forever without having your valuation blow up. It takes care of currencies, it takes care of growth. It is, in fact, a built-in mechanism to keep your discounted cash flow valuations from getting off the tracks. So September 2019, I was actually valuing Heineken. It was for a European audience. And there were 7 people from the Heineken finance group in the audience. So at the time that I valued them, and I was valuing in euros, the risk-free rate was minus 0.5%. I left it there. I said, I know it makes us uncomfortable. You probably think it's too low, but just leave it at minus 0.5% because that's where it is today. It gave them a cost of capital of 5%, really low cost of capital because I'm building off a negative risk-free rate. So far it looks like I'm helping them, right? Low discount rate. But when I get to my terminal value, I gave them a growth rate of minus 0.5%. Why? Because my risk-free rate is minus 0.5%. If I assume that stays stable over time, then my growth rate has to be capped at minus 0.5%. Now, could I assume the euro risk-free rate will increase to 2% after year 10? Yes, if I do that, my cost of capital after year 10 will now have to go up as well. But my value is not going to change very much if I do that, as long as the two are tied together. The bottom line was, even with a negative risk-free rate, the value per share that I got was well below the stock price, which dispels this myth. A lot of people stopped doing discounted cash flow valuations when risk-free rates got low, because their presumption was if risk-free rates are low, everything's going to have a high value. That's not true, because your growth rates are also tied to those risk-free rates. So if you're working in a negative risk-free rate currency and you don't want to change the risk-free rate, that's perfectly okay as long as you make your growth rate forever also a negative number. Just don't disconnect those two numbers, because then bad things can happen to your valuation because you're being internally inconsistent. Now, obviously, when you sit down to value a company, you're going to have a point of view about your company. You say, so and ask you, how long will your company grow? Especially if you like your company, you think it has lots of potential. There's a tendency to say, let's let it grow for 20 years, 25 years, 30 years. Yesterday, I got an email from somebody who's looking at it and says, why do you always cap your growth rate at 10 years? Because my DCF always run 10 years, no matter what the company is. And my answer was a practical one, which is it's true there are companies out there that grow for longer than 10 years. And we can name any of them, right? The Facebooks and Microsofts, the Apples. The fact that we can name companies that have grown for longer than 10 years tells you already that they're the exceptions, not the rule. You know, the median growth period for a growth company is a little later in this class. I'll actually bring in a study that backs this up. It's about 3 to 5 years. Most companies within 3 to 5 years converge on the industry average growth rate. 10 years already puts me at the 90th percentile of growth periods for growth companies. So when I use a 10-year growth period, I'm already assuming you're a pretty special company. If I use a 25-year growth period, you know what I'm assuming, right? I'm assuming you're already going to be an exceptional company. And if I value on the expectation, you will be an exceptional company. Where's my upside? If you're just a really great company, but not exceptional, I'm going to have to lose value. I stop at the end of 10 years, not because I'm not aware of the fact that companies can grow for longer than 10 years, but I want what happens after 10 years to be icing on the cake for me as an investor. So if you ask me, is it okay to go 15 years? Absolutely. There's nothing in DCFs that stops you from using a 25-year growth period. But if you do that, remember, you're already pushing the outer limits of how long companies can keep growing. So don't wait too long, because if you wait too long, you're going to very quickly push up the value for your company because you're making it an exceptional company. And if you think about how long growth will last with your company, you said every number has a story behind it. So you said, why do some companies grow for 3 years? Why does growth fit? Now, I'll give you an example. Groupon, when it first went public, people were just dazzled by the growth rate. And I must confess, I was never impressed by the company. Because as far as I could see, they had absolutely no their only competitive advantage was they got my email address ahead of maybe, Living Social or some other. There was nothing that I could look at in Groupon that let me say, that's special. Many of you are valuing young growth companies where they have high growth in the past, but you say, what's special about the company? You start looking and you can't find anything. I think you need to be cautious about how long growth can last a company if you can't find what's allowing the company to be specially unique. Competition can very quickly start to wipe out growth rates if you don't bring something to the table. Now, I talk to entrepreneurs all the time, and they talk about a product and how quickly they can grow. And the question I always ask them is, what do you plan to do if you succeed? Completely throw them off, right? Because usually they ask questions, what will you do if you fail? I said, what will you do if 6 months from now you're doing much better than expected? You're growing, you know why I asked that question, right? If you're doing much better than expected, people notice you, especially your competitors. And they're going to come after your market. What do you have in place when that happens? Because without knowing the answer to the question, I can't attach a high value to it. So when you think about barriers to entry, this is where it plays out, because companies with significant barriers to entry can have longer growth periods. A young pharma company, when you're valuing a Moderna and you put in a 15-year growth period, you have a pretty solid basis, right? They've patented the mRNA vaccine. It was about 2 years ago. They have 15 years of protection from competition, no matter what you think about the company's future. But if you're taking a consumer product company and you're talking about brand names and the competitive advantages start to get weaker, then you got to get more careful about how long growth can last. And remember the point we made about growth being tied to reinvestment. Terminal value, that rule applies in spades. So when you talk about growing forever, I'm always going to be the skunk at the party saying, okay, but how much will you need to reinvest to get that growth rate? So I'm actually going to take the terminal value equation and restate it. It's actually the same thing that you see in typical calculation, but I'm going to reframe it in terms of how much you have to reinvest to get your growth rate. Remember the sustainable growth equation? That growth times return on capital times reinvestment rate is the growth rate. I did the algebra, and I basically rewrote it in terms of what kind of reinvestment rate would I need? Because remember, once you get to terminal value, there can be no efficiency growth. All that easy growth is gone. It's got to be entirely sustainable growth. Your growth, your reinvestment rate in steady state will be a function of what I assume your growth rate to be and what I think you can earn as a return on capital in steady state. Like this is just the terminal value equation rewritten as after-tax operating income times 1 minus the reinvestment rate. G over ROC is just the reinvestment rate. Just a different way of writing it. But I'll tell you why it's an advantage to write it in this way. When you look at what drives terminal value, then it's not the growth rate, but the relationship between your return on capital and your cost of capital. I know it sounds abstract, but let me give you a very simple example. I've taken a company with a cost of capital of 10%. And I've computed what will happen to its terminal value as my growth rate goes from 0 to 3%. Take a look at what happens when my return on capital is exactly 10%. Changing the growth rate has no effect on my terminal value. If somebody asks you to intuitively explain how you can grow and not increase value, is there a way I can give an intuitive explanation of what it is, what is happening at this company where all this growth seems to be creating no value? What kind of projects are they taking? No, it's not even liquidating. They're taking zero net present value projects, right? Remember the definition of a zero net present value project is you earn your cost of capital. If you keep taking zero net present value projects, you will get bigger, but your value is not changing. So when you assume return on capital is equal to cost of capital, you're assuming your company is in a competitive business. That companies earn roughly the cost of capital. Remember, 60% of companies have trouble making their cost of capital. So assuming a company earns the return cost of capital is already an upbeat assumption, an optimistic assumption. It is true that if you can earn more than your cost of capital, increasing your growth rate will increase your terminal value. Why? Because you're now taking positive net present value projects. Conversely, if you take projects that earn less than your cost of capital, guess what growth is going to do to your terminal value? The higher my growth rate, the lower my terminal value. The next time somebody tells you if I increase my growth rate, my terminal value increases, take a look at what they're doing. Because if they're keeping the cash flow fixed and changing, of course your terminal value will increase. But if you're changing your cash flow to reflect how much you need to reinvest, it's going to be a function of what you assume about your return on capital forever. I'm adding another piece to your story. You're telling a story about your company. I'm going to ask you a question about the long-term story. After the growth is all done, your company matures, what will your business look like? Will it be a business where there are no competitive barriers to entry, a commodity business, in which case companies learn their cost of capital? Or will it be a business where there are still competitive advantages left over, even for mature companies? You could argue that tech companies, because they build platforms and stickiness, might be able to earn more than their cost of capital in the long term. But if you're a commodity company or a manufacturing company, it's very difficult to tell a story where you can maintain returns on capital higher than your cost of capital in perpetuity. Because right now, I have cost advantages. You know what happens to cost advantages over time? Other companies get cost advantages on you. There was a time when Dell had a cost advantage over everybody else in the PC business. You know how long it lasted? Till Lenovo came along at an even lower cost. So think about returns on capital in perpetuity. It's not an abstraction. It's going to drive what happens to your terminal value. I don't know how many of you have read the Mckinsey valuation book. The Mckinsey valuation book came out in about the same year that my first valuation book was published, and they were both published by John Wiley. And if you look at the Mckinsey valuation book, they have a terminal value equation. In that book, they've had it for the 35 years the book has been published. And the terminal value equation is no plat. That's in the numerator, which is just EBIT times 1 minus T. It's their version of EBIT times 1 minus T divided by cost of capital. That's it. There's no plat divided by cost of capital. There's no growth in it. And for 35 years, I get emails from people reading the McKinsey book asking, why is there no growth in the terminal value calculation? To which my response, why aren't you writing to McKinsey? Why are you writing to me? But there's actually a reason McKinsey ignores growth in perpetuity. They make an assumption. They're never quite explicit about this assumption. They assume that if you're a mature company, you cannot earn excess returns. If you make that assumption, you can already see why growth goes out of the equation, right? Because what happens once you earn your cost of capital? Growth doesn't matter. I think it's too restricting because I think companies like Coca-Cola, even if they're mature, will earn more than their cost of capital. Companies like Microsoft, even if they become mature, will earn more than their cost of capital. But if you assume return on capital is equal to cost of capital, then it doesn't matter what the growth rate is. You might as well ignore the growth rate. But McKinsey itself has evidence that their assumption is not true. Now I read the McKinsey Quarterly. It's actually a great magazine to subscribe to. If you go to the McKinsey website, it's free. Get in, you put your name in, you can read the articles that come out of the McKinsey Quarterly. And the great thing about the McKinsey Quarterly is they can look at data that's proprietary, that their clients have given them over time, and ask questions. So this is from like 20 years ago. McKinsey did a study of what happens to revenue growth at companies as they get bigger. And guess what? They found that as the companies get bigger, revenue growth declines, which is what we assume in DCF. They also looked at what happens to returns on capital as companies mature. And guess what they found? Returns on capital don't decline, which means assuming return on capital is equal to cost of capital might not be a good assumption for every company. So if you see the McKinsey equation play out, ask the person using the equation, are you assuming that the company's returns on capital, they have no idea what they're talking about. They haven't thought through what they're implicitly assuming when they use that equation. Now, one of the most disastrous things that I see in discounted cash flow valuations is in a lot of DCFs, you get to your stable growth. You'll assume your company is a stable growth rate. And then the analyst will make a collection of assumptions. And you tell me what you think about it. They'll say, mature companies don't need to reinvest. So net CapEx is zero. CapEx offsets depreciation. Mature companies don't have working capital needs. Working capital change is zero. And then they put a 2% growth rate in perpetuity. You see the problem with assuming a 2% growth rate in perpetuity with no net CapEx and no change in working capital? I think I remember my 0 times table. The first table I taught all my kids because they wanted to earn money. They got $5 per table. I wanted to start out easy. The nice thing about the 0 times table is 0 times any number is 0. A 4-year-old gets that 0 times 1 is 0. Then they extrapolate from that and you guys say, well, no, it doesn't work with any other number, but it works with 0. If your reinvestment rate is 0, your growth rate has to be 0. And I'll tell you what makes this argument from analysts so alluring. They say, my company is just growing at the inflation rate. You see why this seems to suggest you don't need to reinvest, your capacity already covers it. Why would I need to reinvest? What's the problem with that argument? That if you're growing at the inflation rate, you don't need any reinvestment. It's true, you don't need extra capacity, right? But your existing machines run out and they got to get replaced with new machines. Your equipment wears out, you have to have new equipment. You very conveniently assume that inflation was helping you when you did your revenues and earnings. But now when you replace your machines, guess what? The same inflation is going to come into play because the machines you're replacing will cost more than the old machines. If this were not true, you know what would happen to the returns on capital of companies as they get older and more mature? They're going to go to infinity, right? And they don't. They very quickly start to peak and come down. Declining companies are dropping returns on capital. There is no escape hatch here. If you put in a growth rate in perpetuity, you need to assume enough reinvestment to sustain that growth rate. And that requires making an assumption about returns on capital, even if the growth rate is equal to just the inflation rate. And finally, when you put your company to stable growth, give it the characteristics of a mature company. What am I talking about? I already talked about how returns on capital converge on the cost of capital. We talked about how reinvestment rates will come down. But I'm not done. Remember, we computed a cost of capital for your company? That was based on your company being a growing, risky company. Now you're a mature company. Your beta has got to be different. Your debt has got to be different. You've got to give the company the cost of capital of a mature company. So if you're valuing a young company in US dollars and you give it a 10% cost of capital, I'm okay with that. It's a risky young company. But when you give this put this company to terminal value, you can't leave the cost of capital at 10% because then you're making your company a mature company and giving it the cost of capital of a young money losing company. That's why I allow cost of capital to change over time. I don't think I've done a DCF valuation in 20 years. My cost of capital doesn't change over time. I do it because I need to be internally consistent. So I'll close with that because that basically covers all of the issues. I'll send you a series of 5 blog posts I put on terminal value that kind of cover everything we talked about. Read them when you get a chance, because this, if you're doing DCF, is where you're going to have your big arguments about how to do this. I will see you on Wednesday.